Welcome everybody. My name is Elizabeth Viverito. I am manager here at Small Business Banking Network of Membership and Community Services, which includes the website and the web community. And we're very excited to continue our webinar series for 2012. This particular series is part 1 of 2. As you can see, this webinar today will discuss birth to growth stages in the life cycle risks for small businesses. And then on October 17th, we'll be having a follow-up webinar that tackles the stages of maturity, revival, and decline, also facilitated by our expert Almeen here. So we do encourage you to view local times and register at the link provided there. I will go ahead and introduce our topic facilitator for the day, Almeen Vandermeer. Almeen has more than 20 years of experience in risk management, audit, compliance, and interbank negotiations and payment. She is based in Pretoria, South Africa currently, and she has quite a lot of those years in the banking and financial services industry. Currently, Almeen is a director on an accounting and consulting firm, and prior to that, she was working with Tiba Bank in South Africa, where she looked after interbank and regulatory payment relationships and also managed a transactional product portfolio of around 2 billion South African rand. Almeen has engaged in quite a number of projects in risk management aimed at small and medium enterprises, which have been implemented in countries around the world. And she has been appointed director to the board of a company representing smaller South African banks in the payments industry. She has been recently also working on a retail product in China.
Thank you, Elizabeth, and welcome to everyone for this webinar. I hope that you will enjoy the next hour with us and find this topic beneficial to your institution. What we will cover, small businesses can grow fast and spin high returns, but this also means very high risk. As they grow, they are faced with adverse influences, not only internally but also external factors often determines the fate of the businesses. This webinar highlights risks to watch out for at the first 2 stages of an SME's life cycle and methods for mitigating each step. We also discuss how to make these a regular report at your institution. We endeavor to give you the tools to identify life cycle stage in which the company is by giving you a couple of pointers to look out for and also give you a list of holistic risks per life cycle stage, which you can be able to identify with corresponding mitigations and controls. So why do we look at organizational life cycle concept? A study was done by Watson and Chandler in 1993 that concluded that there is an estimated 55% failure rate for small businesses within their first 5 years and a whopping 81% within 10 years. According to the Global Entrepreneurs Monitor report, the prevalence rate for new businesses is only 2.1%, while for established owner-managed businesses, it's a mere 2.3%. The life cycle concept has been researched by many leading experts, and there are many models based on this concept. The commonalities for all of this research is that it is based on predictive models. It's linked to growth and development of organizations. The different stages in the life cycle is directly proportionate to the internal and external factors. The importance of the life cycle model is also based on premise and prescription. Premise in terms of the requirements, opportunities, and threats will vary depending on the stage that the organization is in, and prescription in that different stages require alteration in the way management treat the objectives, strategies, managerial processes, technology, culture, decision-making, in order to ensure success or survival for the company. Entrepreneurs who are involved in the early stages of business creation are facing concerns such as securing financing, establishing relationships with vendors and clients, preparing a physical location for the business operations, and other aspects of business startup that are integral to the establishing and maintaining a viable firm. Basically, this entrepreneur or this firm are almost exclusively concerned with the very first stage of the organizational life cycle. We have already said that the life cycle concept is based on predicative models linked to growth and development of enterprises. The different characteristics of the organization and the risk that they face can be predicted at each of these stages.
And Almeen, I wanted to break in here with a question. One thing that we were wondering, is there an optimal balance between the number of clients you have in a birth stage versus a growth stage or any other stage?
Elizabeth, that's a very good question. With not so simple answer. The number of clients is definitely key, but I would think that it's more important to ensure that the structures are in place to ensure that the number of clients can be efficiently supported, to ensure that the structures are efficient enough so that the company is not at risk having to serve the number of clients. And it also depends on the risk strategy and the risk appetite of the organization and ultimately the bank.
Thanks, Almeen.
The birth of an organization is based on an idea of a product or a service that a need for exists in the market. A small business also doesn't start off with appointing a full employee complement. It's usually managed by the owner with skeleton staff and little procedures. The birth stage is all about establishing the business, establishing business relations, establishing relations with the bank, securing startup capital, and securing premises to operate from. Moving on to the growth stage. Once the business is set up, is done in terms of its premises, bank relations, etc., and the product or service has proven to be viable, the company moves to the growth phase. The growth phase deals with securing more contracts, increasing the number of customers, formalizing an organogram, splitting of tasks, and this is often when the entrepreneur appoints family members into the organization. Formalizing reporting and management structures as the business grows, and incorporating financial systems is also a characteristic of the growth phase. If we look at the differences between birth and growth, it basically boils down to shifting the emphasis from establishment to expansion. The product or service showed to be viable, and therefore focus moves from survival to growth. We have also said that it often happens that business owners appoint family members in certain key positions as the business grows, and this phenomena often leads to the term family-owned businesses. It has transitioned from one person single offering to a more managed, differentiated service product offering, increased procedures and structures as the business grows, and then a change in management style. While many factors could contribute to the downfall of a small business, Moores and Muller in 1998 are of the opinion that one of the major reasons for business failure is the lack of managerial experience and capabilities. More specifically, they concluded that the small business sector shows an absence of financial acumen, marketing, entrepreneurial flair, practical knowledge, and human resource management. These pitfalls mean that many businesses fail to reach their full potential and to grow. Single contracts are the biggest risk in any organization. The entire existence of a company is based on one single contract, and should that contract cease to perform or exist, the company falls flat. Raising capital might also be a cause of high risk. Owners of startup businesses, which often go to any length to get the startup capital and then agree to unsustainable contractual commitments. In China, they have legislation which protects all investments made by SMEs. The state protects the lawful investments made by small and medium-sized enterprises and their investors, as well as the legitimate profits earned from these investments. The implication for the bank is then that they cannot lay claim on any of these profits, and the SME can refuse to make payments based on this legislation. It is therefore important for the bank to ensure that owners and the SME signs personal surety for all loans made by the SME. Looking at the growth stage and putting that into context, I have to highlight again the risk of single contracts, of one contract contributing to most of the business turnover. It often happens that once business owners realize that there is a great demand for their product or service, they tend to concentrate heavily on marketing and getting new clients and ignoring the back-end systems or structures as they go along. This is a huge risk, as it can happen that the business is contracted to deliver, but then find that they cannot do so as they do not have the capacity, and this results into penalties and or reputational risks. I also want to refer you to a document that we have in the Knowledge Bank on the website under the risk section, and it has to deal with, and it deals with red flags in credit management, and it's a very useful document that you can work through. Also, in the growth stage, the owner realized that they need additional capital to fund expansion and growth. There's high employee turnover, and is the succession planning in place? Owners tend to take more money for personal use. For instance, they don't apply the whole loan to business and they draw more funding out of the business. Management and business experience are also not in line with the business growth. Again, looking at birth and growth stages and contexts, single contracts or the concentration of sales in one customer segment is a huge risk in both these stages. Birth stage, there are often more control than in the growth stage. The growth stage structures are normally insufficient to support the high growth. Overcommitment of loan repayments to finance business growth and or startup. Management experience is key in terms of cost management and inventory control. It's important to note that there is not a definite line between the transition from one stage to another. It might take a couple of months or a couple of years, and in such a case it is important for the loan officer or the credit analyst to put these risks of both the stages in context. Risks in the birth stage. It is also important to note that this is obviously not an exhaustive list of characteristics and risks per stage. These couple of key points strive to illustrate the relationship between the organizational life cycle stage and a specific characteristic and a corresponding risk. The entrepreneur in the birth stage are concerned with setting up business and establishing the framework for the business. And in doing this, they often ignore the accompanying risks. There are a number of risks in terms of the way the business is set up or the way the business is established, in terms of the owner being the only key person, or there's no delegation, the owner is the owner, and everything, the viability of the business revolves around the owner. It is also a high risk in terms of the lack of business capacity or experience, leading to unrealistic forecasts and budgets. Again, in the growth stage, we look at a couple of pointers to look for when dealing with a small business, and then we list corresponding risks that should be considered when granting credit. I cannot stress the risk of single contracts enough. In 1994, legislation changed in South Africa that determined that all contracts held with government should comply to Black Economic Empowerment status. This meant that SMEs that were not partially owned by previously advantaged groups, lost their contracts with government. These companies were probably in existence for 20, 30 years. They were extremely profitable, some of them family owned, and they've been very successful. And suddenly new legislation came into place and they lost the contracts. This also meant that they default on their loans. Therefore, it's extremely important to look at single contracts and to highlight that as a risk in your organization.
Elmine, I think that's a very astute comment to point out, especially with the example in South Africa. One of the questions we've heard is, do the stages, characteristics, or risks vary between sectors? For example, manufacturing versus agriculture versus retail. Can you comment on that?
Yes, definitely. In this webinar, we try to cover the more holistic risks that should be applicable through all sectors. However, there are definite risks and characteristics that should be noted per sector. For instance, the compliance to safety regulations in a manufacturing organization would definitely not be the same as in a retail environment. So there are definitely sector and industry risks and characteristics that you should note as you assess your risk.
Thank you so much.
Thank you. Mitigation strategies for the birth stage. Mitigation strategies for small and medium enterprises often rest with the business owner, and the bank has limited influence over this. However, the bank can guide the owner and also insist on some mitigants when granting a loan. For instance, personal surety signed by business owners on the business loans, life cover for key individuals, review the contract and insist on legal documentation for key relationships. Also look at things like system support. It should preferably be done by a trusted and established company. And this mitigates the risk for the bank to some extent in terms of the fact that they know should something happen to the company systems, there is a backfall or a backdoor in terms of a trusted and established company. Key individuals to make sure that there is a flow of funds should something happen to the key individual in this organization, so that the company has enough time to appoint someone else in that position and at least be able to service the debt payments over that period. The importance of life cover is often understated, but it can be an effective mitigation strategy. If your bank provides for a long-term insurance product, it is not only a wonderful cross-selling opportunity and creating revenue for your bank, but it also provides you with more qualified information such as the owner or the key person's health status, spendable income, etc. Insist on attendance to financial education programs that the bank subscribe to. You do not necessarily need to have your own financial education programs. There are a number of these programs that you can buy or that you can pull off the web. Visit business premises often as you can. Advice on financial booking systems. There's a bank in South Africa that offer a free accounting package and advice with every business account opened. And that is a brilliant idea because first of all they ensure that the business owner do have accepted or do use accepted bookkeeping standards and systems. And also it helps with balancing the SMS books at the end of the month. And that mitigates risk for the bank. Monitoring is directly related to risk. You probably will not spend the same amount of time and effort on a $5,000 loan than you would on a $50,000 loan. I prefer using a dashboard approach in reporting to Management and Risk Committee. It is easy to read and understand, and you can probably report your whole book on a couple of pages. It is important to ensure that your reporting risk parameters have been approved by the risk committee and that your report audience knows which parameters these are. Red flags that you can report on are, for instance, deposit turnover, funding of checks, inconsistency of financial information, financial ratios, changes in inventory levels, change in management, single contracts, and you have to make sure that your actions relating to these high-risk signals are also approved by your risk committee. Controls should be linked to red flags and the dashboard. For instance, changes in inventory level can indicate either stock not selling, thus dead stock, or high inventory or high turnover lines not being replaced. And that's a huge red flag for a small enterprise. Deposits not enough to cover expenses, or rolling credits and checks to cover expenses. That is a huge red flag. Insurance premiums lapse might indicate cash flow problems, which is a red flag in itself. And there again, showing the importance to having the cross-selling to insurance or long-term insurance products. Changes in salary amounts might indicate high growth. Insurance systems are in place to cover the high growth, or that might indicate retrenchments, which is also a red flag. This is a framework of what should be monitored and at what stage. The slide only lists a few items, but the list can be exhausted to fit industry profile or can be client specific. You can also use this framework to build a dashboard. For instance, in South Africa, there are a couple of regulations you have to comply with if you operate as an estate agent. For instance, you have to have a valid registered business. You have to do the estate agent's board exams. You have to be registered with the estate agent governing board. And you also have to be registered with the Financial Services Board of South Africa. If not, the business can be closed down. These are the type of things that you can put into your dashboard or into the application document in terms of a tick list to ensure that all of these compliance regulations are covered, therefore your compliance risk for the SME are covered. In terms of the birth and growth, looking at monitoring control, for birth, look at legal documents, look at life cover as we've discussed. Monitor the bank account. We've also discussed that. Your industry trends, for instance, the property market. If your clients are in the property market and the property market is turning downwards, that is a red flag. That raises a red flag with your credit analyst. Look at budgets, forecast, compliance to legislation, the number of clients they have at birth, and again I come back to the single contracts. In the growth stage, you will look at the financial statements, look at financial ratios, management accounts. Again, look at how the organization handles its bank account. Look at the amount of deposits coming in, the withdrawals. Should the company do foreign trade, monitor the exchange rate. Changes in the industry, changes in staff numbers can tell you a lot about the company and where the company is going, and also highlights some risks on hand, relation between receivables and payables. In summary, business face different risks in different stages of the life cycle. Birth and growth phases are very high risk. Research shows that most businesses fail within the first 5 years. Your effort in assessing risk must be in relation to the bank's risk. Monitor your key risk, act on red flags, and trust your gut.
We have had just a few questions, and if anybody else does have questions, you can type those into the chat box. And one of the questions I wanted to read out for you, Elmine, is what are the implications of this approach based on who in the institution should be trained in this approach? Is it only pertinent for the risk management department, or is this useful for other people institution-wide to understand?
Elizabeth, this is definitely institution-wide. This approach is extremely important for loan officers and frontline staff, especially in a smaller institution where the loan officer is often the only point of information sourcing. The credit analyst must rely on the information that the loan officer got. This approach is therefore crucial for both loan officer and the credit analyst in order to assess a company or an application in terms of where the organization is in its life cycle. This approach can therefore be used as an additional tool to assess your credit risk. It is in no means meant to replace your existing procedures, but it lends to identify and narrow down on specific risks that might contribute to your default rate.
Thanks, Elmine. There was another question asked, what is, in your experience in South Africa, what's the best approach to train staff in identifying these stages and risks?
Elizabeth, the first step is to make staff comfortable with the organizational life cycle concept. It is really not a difficult concept to grasp, but the implementation thereof might be more complicated. I suggest that a template be drawn up very much similar to what we've done here today, and use that as a tool to train the loan officers and the credit analysts.
Thanks, Elmine. We have another question from the audience here. The question is, does this relate to start-up businesses? Most banks and MFIs have a deliberate policy not to fund greenfields. What's your perspective?
Yes, definitely. Definitely. I think, as we have said throughout this webinar, is that startup businesses is very, very, very high risk. Using this framework, and we only cover the holistic risk, but if you streamline the risks per sector, looking at startup businesses and also the businesses, growing businesses, you can definitely checklist a couple of risks that you should look out for in terms of your startup businesses, and making sure that those risks are covered.
Thanks, Elmine. I like that question. I think that might be another good debate that we could take back to the web community. Elmine, one additional question. Is there an additional risk when a business is very, very small and there's only one principal? And what about if that person is very sophisticated?
Yes, definitely. If there's only one principal, he would definitely also be the key person. What would happen should he become disabled or in a car accident, which is a very real risk in our society these days? Make sure that the key people or the key person is fully insured, as well as that your loan are covered, that you grant this business. Again, stressing the importance of cross-selling as a mitigation in your bank.
We have another question from the audience here. From Rwanda. According to your experience, what can you suggest in order to prevent the risk in the birth stage of the enterprise? So is there anything that as a banker you can do to help prevent or mitigate this risk?
In the birth stage, startup businesses, definitely. Compliance risk is a huge issue. Looking at single contracts, and I keep on hammering on the single contracts because that is almost always what a new business is based on, either a single contract or a single product. Highlighting these risks, as we have done in the webinar, would definitely cure or curb your risks as a banker. Looking at unrealistic forecasts and budgets, an entrepreneur would not start his own business if he wasn't optimistic. So double check those forecasts and budgets. Also look at contracts in terms of raising capital and contractual commitments. Those are extremely important because your entrepreneurs or your startup business owners would go to almost to any event to raise this capital to start their businesses. So there's a couple of pointers to look out for when dealing with a startup business.
Thank you, Amin. Are there any last comments or final thoughts that you'd like to leave us with today?
Yes, I think for the startup or the birth and growth phases, we've gone through a lot of information, and a lot of these seem very much holistic. But I would like to encourage you to take this back, and if there are any questions, please put them up on the web. Let's discuss them. You can email Elizabeth or David or myself if you have specific questions on this topic, or if anything was a bit unclear throughout the webinar. We would love to help you and to clarify. And I really hope that you will join us for the next webinar on the next 3 stages.
Thank you so much, Almeen, and we're very excited for the next one. Thank you to all of our participants who logged on today and contributed either by sending us emails or sending us questions online. We really do appreciate your attention and input and engagement. And we will hope to see you on October 17th for the next webinar on this topic, and in the meantime, on our web community online.